Happy Monday, everybody. I hope you had a great weekend. Today is the last day of July, the 31st of July, 2023, and this is your Monday market update. Recently, I read the following headline. Yesterday, the Dow and S&P had their worst day since May. May? It's only July. Really, it's saying that it's the worst in 2 months, anything but fear-mongering. This is so short-sighted. I usually save this till the end of the video, but let me make this clear. While the Monday market update is all about day-to-day market action and week-to-week reports, this is not the key to your long-term investment future. Setting goals, planning for those goals, setting up your individual plans, implementing those plans, monitoring those plans, and making the necessary changes to the plans, then rinse and repeat. That's how we work together to do all that we can to succeed in reaching your goal. We'll talk about that in our meetings, and you can also find information supporting that on the Friday planning videos, so watch that. So now back to the Monday market update. Last week was a full week of earnings, eco data, and central bank news. Let's jump in, recap last week, and we'll preview the coming week. Stocks started the week with a gap higher as it recovered from some of the slight declines from late in the week prior. This was more momentum and the glass half full mindset, as I spoke about last week, as rose-colored glasses. European eco data was out. A National Association of Business Economics survey was also out. 71% of them expect a recession in the next 12 months. U.S. eco data, the PMIs, manufacturing, and service numbers were a bit disappointing, but in the end, all negative news was ignored, and the markets closed near the upper end of the trading range. Dow was up 0.5%, S&P up almost 0.5%, and the Nasdaq up about 0.25%. For Tuesday, futures were back and forth between red and green before the open as the market was grasping at news in a pretty quiet place. There was the ECB's lending survey that showed that in the EU, demand for loans and financing by corporations fell to the lowest level since 2002. Slew of earnings were pretty solid and most topping estimates and even raising guidance, and that kept things going back and forth. The market churned higher, consumer confidence is at a 2-year high, and 1-year inflation expectations remain high. Focus was positioning for after the close earnings. Microsoft and Google's were the headliners to come. There was a lot of business news flying around later in the day. UPS and Teamsters came to a deal, and that removed the worry on the possible UPS strikes. UAW and General Motors next on deck. PacWest Bank agreed to be bought by the Bank of California. Oil is back around 80. Dow closed up slightly to make it 12 in a row, less than quarter of 1%. S&P up about 1/4%, and the Nasdaq up just over 0.5%. After the close, we did get Microsoft and Google, and though I stay away from too much stock-specific news here, I will say that these two conference calls went on. The term AI was said over and over again, more than 90 times for Google and 73 times in the Microsoft call. Markets were primed for Wednesday's Fed rate decision, and the presser, just to note, the Fed whisperer, Nick Timiraos from the Wall Street Journal, the one who seemingly has the bat phone from the Fed, did write that the Fed isn't ready to declare victory on inflation. He went on to say that economic growth has likely been too strong for central bank officials to validate investor expectations that this will be the last hike. I focus on this since as much as I talk about valuations and earnings, the Fed still is holding the spotlight in the short term. Overall, equities markets gapped lower on Wednesday, aka Fed Day. As I mentioned, Microsoft weighed on things as the markets got started, and once that selling was done, on the open, the market did the normal Fed Day shuffle, back and forth, much ado about nothing. As the decision was released, the fizzle was heard in the room, as pretty much nothing changed, and there was nothing that was not expected in the release, almost nothing. Things picked up again, got exciting again when Powell's presser got going. As we've been saying, overall, his report was all over the place, and markets followed. Markets rallied when Powell said that the committee is yet to decide about what they're going to do at the next meeting. Wow, that's newsworthy. Really? Of course not. But markets like that. Then everything reversed when he pushed back clearly on the idea of cuts this year, and even more so that if the data warrants, the Fed is prepared to hike more and keep things higher for longer. Nothing new here again in either of these things. Then the news, although not such news, the Fed, like the comments by Janet Yellen I talked about last week, said that they do not see a recession this year and that they see a path to a soft landing. That brought things back a bit. You would not describe the market action as sound and fury, but if you did, as I like to say from Shakespeare, full of sound and fury signifying nothing. The Dow closed up 0.25%, S&P down ever so slightly, and the Nasdaq down barely as well. We'd like to think that we can focus on something else for a while. Fed will not meet again until September 19th and 20, in case you're worried about that. They will get together on their annual trip to Jackson Hole, Wyoming, but not an official live meeting again until September. While they're gone, let's focus on earnings and valuations, as I've been telling you about. We'll preview in a moment, but I'm sure you'll get the Fed head parade restarted. But trying to steal the limelight over the next 8 weeks will be 2 CPI reports and 2 job reports, along with with a lot of other eco data, home and overseas. So data is what they will crave, and we will have it. And that will keep the airwaves full of commentary, so we'll see how that goes. Thursday was the one to watch. Spoiler, the Dow was not to meet the record from 1897. Sorry, if it would have made another green day, it would have tied the streak, a 14th in a row, not seen since Queen Victoria was on the crown. 13 was the lucky number, not 14. Dow stocked. Earnings and upgrades helped the markets open higher. McDonald's with great earnings, Boeing with an upgrade. Non-Dow stock Meta, the old Facebook, led the upside on the tech end. Great earnings and outlook. By most analysts, not all, markets took it up by 9% pre-market. GDP growth was a bit ahead of expectations, and that still points to a strong economy, good and bad, which glasses you're wearing. Just a quick note on this Dow streak, 75% of the gain for the year in the Dow has come in the last 13 days. Just a note. July 7, the Dow was up 1.77% for the year, into Thursday up over 7% year to date. Remember the idea of FOMO, fear of missing out. By the afternoon, the bloom was off the rose, the markets rolled over, and the streak was in jeopardy. By the end of the day, the Dow was down. Yes, it happens. Dow down about 2/3 of 1%. S&P also down about that, and the NASDAQ was down about 0.5%. Nothing huge, but the air starts to come out. The markets took notice. On Friday, the rally resumed on the back of the big three inflation reports. That is core PCE, employment cost index, and one-year inflation expectations. All meeting or coming in under expectations, and this time under is good. Disinflation is still the word of the day. Bank of Japan moves late Thursday. Did not throw cold water on the markets here, so the markets maintained early gains, closed strong for the day and for the week. The Dow was up 0.5% for the day, S&P up 1%, the NASDAQ up almost 2% on the day. Into the weekend, for the week, strong one. The Dow and the S&P both up about 4.75%, NASDAQ up 5.33%. Overall, earnings and eco data both supported the move, or at least the direction of the move. Going into this week, there are many who are in the full speed ahead camp since the inflation is going the direction the Fed wants. Those of us, myself included, who are not in the momentum only camp are a bit cautious, at least in the near term. Please don't get me wrong. Overall, I'm very much in the belief that we will get a soft or soft-ish landing. I'm not sure when it'll be, when we'll be able to really call that, but I do think the economy crashing down is not in the near-term cards. Again, in my opinion, don't let anyone scare you with there will be a recession comment or excite you with there will be no recession comment. We've talked about time horizon over and over again, and I'll focus you back on that again. Recession is just a part of the economic cycle, and I, for one, do not think that cycle's gone away. Boom and bust, expansion, contraction, call it what you want. There will be a recession sometime. Three major factors that have to be considered when you say that. Number one, when. Number two, deep or shallow recession. And number three, short or long. So as you've heard me say, in my opinion, we have already had a technical recession as defined by 2 successive quarters of negative GDP growth, but that was during COVID. So in my opinion, we will have a recession sometime soon, but it'll be short and it'll be shallow, and it's already been priced in the market. So we'll have to see how that plays out. Correction in the near is the next term I want to hit quickly. Again, my opinion here. The idea of a correction in my mind goes to what I saw over and over again in the 1990s, so many times since. Rolling corrections will happen. That means that certain stocks and certain sectors will correct. We reported this a lot in the past. Just to give you an example, 2022, last year, energy returned to close to 65% on the year, positive, not so this year, and communication services were down almost 40% last year. If you had exposure there, you had a boom or a bust in 1 year. This has been going on for decades, and I don't think it'll stop. So that leads us to this week. I've been telling you that the focus will move away from the Fed, and although I'm seeing less of that, I still think it'll happen. The Fed will not meet again until September. There will be 2 CPI reports and 2 job reports before that. There will also be countless Fed heads hitting the airwaves to chum the waters and float some ideas to see how the market wants to react. In the meantime, I maintain my opinion that it will take more than Goldilocks eco data to keep this rally going. Yes, this will be about earnings, forecasts, and valuations. This week, we're in for another big earnings week. Apple and Amazon will both be watched, but so will many of the big pharma names and some of the other names of interest when it comes to our daily lives: Uber, Starbucks, Airbnb, PayPal. Also watch for jobs data, not just Friday non-farm payrolls, so that'll be the big one. We'll get JOLTS, ADP number, and jobless numbers too. And this, right or wrong, will be headlines. Fed heads will only hear from a few in my research, but more could pop up. Goolsbee and Barkin are set to talk. We'll also get the reads from manufacturing and service economies, and not to be left out, Bank of England will weigh in late in the week. That'll keep us quite busy this week, and I think the keys to the market this week will be Amazon and Apple, and how people will hear them. We'll see if they can beat the AI reference record from Microsoft and Alphabet calls, and that to the jobs info, and you'll see how the week goes. Today, we'll bring July to a close, and it looks like it'll end as a pretty solid month. So how does the sell in May and go away look for now? I don't know. We'll see how that goes. Please remember that although the market often acts, in my opinion, more like 95% psychological and only about 5% logical, we have to be logical at all times. We will stay focused on your goals, use the market dislocations and actions to help us do our best to get you there. Come back on Friday for the first August planning video, and check out the new August blog on the website. Keep in touch and have a great week.